All right. Take two, folks. Welcome back to this Wednesday edition of Benzinga's Pre-Market Prep. Spencer Israel, Joel Conan, Dennis Dick with you guys. We are here live from the Benzinga Global FinTech Awards and New World stages in New York City. So we just ran through a bunch of stocks before. We ran through Macy's. Actually, we only did two stocks in like 10 minutes. We did three. We did Macy's, we did Kohl's, we did CSIQ. You guys want to run through the Macy's numbers?
We're running through Macy's again. Give us the numbers on Macy's because it is the story here of the day. Hopefully everybody can hear me. Let me know, chat, if you can hear me now. But Macy's is the story of the day, the big pop here and huge sympathy moves.
Story of the day, Macy's. Q1 EPS, the GAAP EPS, 45 cents. The adjusted was 48 cents. Regardless, it's all good because the estimate was only 35 cents. So they beat that handily. Sales, $5.5 billion versus $5.39 billion. So they beat that. Comps up 4%, raised the sales outlook and the EPS outlook for the fiscal year. And they said they'll remain active on Alibaba's social media channels. I guess they have a relationship with Alibaba there. So all good things from Macy's.
And stock getting a huge pop. I wish everybody could have heard the show before because we were talking about Macy's and it was trading up, Joel, to $34. I was like, wow, this is getting ridiculous. And you saw a lot of the sympathy moves trading all the way up to, and I don't know if anybody could hear me talking before, but we're talking about Kohl's trading up almost to $66. Dillard's is still a bit up here at 76, which I think is overdone. And actually, I think I'm actually might be going and trading some Dillard's here right now. But Joel, take over here. I'm making trades.
I told you to short it at 34, Dennis. Once again, you're not paying attention to your mentor. Nice whole number, 34. That was a little bit above a couple weekly highs that you had, 33.56, 33.73. That 34.10, I don't think you're going to see that again here in the session because everyone that bought it, we're talking Macy's here, everyone that bought it up all the way to 34 and change. Now a little bit underwater. Also, even got a good 34.37. That was your February of 2017 highs. So Macy's finally back in the 30 handle. We'll see if it can sustain. And we talked about the report, the sympathy moves that Dennis talked about. His primary sympathy move was Kohl's. Would have liked to see it get into the 66 handle. You had a couple monthly highs at in the upper 67s, actually, upper 66s, actually 67.
Where did Kohl's get to when we were talking about it?
It came up shy. It only got to 65.70.
Still, though, up 4%. I mean, and the leader was giving it back already. Man, that was a gift.
Yeah, and who else? Oh, JCPenney. Is it back under $3 or over $3?
It's $3 here right now, 302. Even JCPenney trading up here on the Macy's. But again, keep an eye on Macy's. Macy's is leaking here right now. So I'm not sure a lot of these stocks that are trading up 4 or 5% in sympathy here feels a little bit overdone when your leader's up 8. So just keep in mind that Macy's has come significantly off the highs. Not saying to come in here and short all these things, but I'm not coming and buying Kohl's up $2. I'm not coming and buying Nordstrom up $1.50 on these earnings. And, you know, Dillard's here trading up almost $3 right now. Somebody's got an iceberg bin there, so somebody thinks it's going higher, and maybe they're right here. But I've been trading. I played a little bit on the Dillard side here, short. So we'll see what happens.
Found something that is combing the ditches for retailers.
I'm looking for retailers that pop too much. You know, I mean, a fader. They call me. If you ain't trading, you ain't, or if you ain't fading, you ain't trading. They used to say.
Oh.
So. I sometimes works and sometimes doesn't. Isn't that the way with everything?
Joel, did you learn any new trading idioms from any of the people that you spoke to yesterday? Kenny Glick. You should have seen Joel and Kenny Glick, man. They were two peas in a pod. Those two.
I will have to say, I mean, there's no one else around. Probably the most valuable fintech-er, the MVFT, Kenny Glick. He came here suit and tie, networking the entire day. Just a really fun. We're going to have to start include him more in the broadcast. And just one other thing I wanted to throw in there, and I was trying to explain it to Dennis, and he had a little hard time understanding it. Spencer wrote about a guy named Morgan Field. He's from a company called Acorn. And if anybody in the chat room here has, you know, young kids or kids in high school and college, and you want them to get them started in investing, I encourage you to get the app. And what it does is, let's say I decide to do it and I link it to my Visa card, right? I guess you could call it a brokerage account. So let's say I go out for breakfast today and I spend $8.50. What the app will do is it rounds up to the nearest dollar, and it takes that 50 cents and it deposits it into this brokerage account. And then it gives you 3 or 4 different options, an aggressive fund, non-aggressive and conservative.
Neat idea.
And, yeah, it's a neat idea. And the funniest thing is I was talking to the guy about it. I was talking to a lovely PR person, Morgan, and talking to Bill Santiago. And he's like, it's the greatest app in the world. He had it. He pulled it up. He had like 1,800 bones in there. And he also
just from saving his pennies.
From saving his pennies. And you also, like, let's say you just like feel like depositing $10. Boom. You don't have to wait for the app. You can go and immediately deposit the $10. And also did a nice interview with Bill. But he says that he listens and makes a lot of his investment decisions while listening to old versions of PreMarket Prep when he's on the New York bus
Nice.
or on the subway. But that was a major segue here. I won't divert from that again. But let's talk a little bit.
I mean, just the Acorn thing, I'll just give my commentary on it too. That's
Sure,
a neat idea. And I can remember doing like a little project in university there, taking finance and looking at annuities and looking at if you could save a penny a day. And I was taking the penny and then investing the penny if you could invest at 5%, 10%, 15%, or 20%. So just saving 1 penny a day and then taking the average life expectancy of a person of 80 years. That 1 penny, if you could invest at like 10%, you know what it turns into? 1 penny a day? It turned into over like $100,000. That's crazy. You think 1 penny a day, but if you can invest that 1 penny and make 10%, it's the power of compounding. And if you can invest at 20, it like made you like a millionaire. If you could get to now 20% is very, difficult to get, but it just goes to show you the power of those pennies. So it's neat that Acorn app built on that. And you're not just saving 1 penny, obviously you're saving significant pennies. You're saving 50 cents sometimes if you're rounding up to the dollar all the time. So it's a good way for people to save that have a difficulty time saving. Now I'm cheap, so I don't know if it works that if it helps me that much because I'm already cheap anyways and I save a lot. But if you have a difficult time saving money, what a neat idea.
I know I'm gonna get Dana and Emily on this for sure. But you want to talk a little solar?
We could talk solar. Canadian Solar did report earnings here. It's trading down the pre-market. We had Gordo on the show here a while ago, CSIQ, and he didn't give it the love. And I follow Gordon Johnson. I'll tell you again, he's not widely followed on the street, but he calls a spade. And he's the one that I really believe, he really knows what the hell he's talking about. A lot of the analysts do, but a lot of the analysts don't. I like Gordon Johnson. When he says buy something, I usually do. When he says sell something, I usually do. He got bearish on Canadian Solar when I owned in my portfolio up there around 1750 or 1760, and I sold it that day. I was like, Gordo don't want it, I don't want it. And it was a good sell because the stock went down to $15 after that. It has come a long ways back, so I'm curious what Gordo's thoughts is on it now after this report. But it did report earnings, Spencer. Give us the details.
Yeah, I don't know if they had estimates, but the number is Q1 EPS 72 cents, 1.42 billion in sales. The Q2 sales guidance, however, was bad. There was an estimate for that. The estimate was $998 million. The actual sales guidance they gave was a range of $690 to $730 million. So a big miss on the Q2 sales guidance.
Stock trading down slightly. I don't know about that offer too from the CEO, if that's still on the table. Remember, he was offering to take it out, get it
something like
$18 or $18.50 was going to take the company private. But then Gordon said, I don't even know if I believe that. So Gordon don't believe it. I don't believe it. We've heard crickets about that since, and the stock's obviously significantly down from there. So obviously the market doesn't believe that potential take private offer either, or we'll be trading substantially higher. So 1657, it's down slightly. Solar has been hot though. And you know what? If you're just looking for pullbacks here, I don't know if Canadian Solar's your gun, but First Solar has blasted off into orbit the last 5 days. Also, if you look at this nice ETF, it's called TAN, great ticker symbol, Guggenheim Solar. TAN is up about 5% in the last week and a half. So Solar's been hot.
And do you remember what the catalyst was in the First Solar a couple days ago, Dennis?
No, goldfish memory. Enlighten me.
Feeble mind. California mandating, I believe, 2019, 2020, that houses, unless you're in a particularly shady area, will be mandated to have either also not all solar
Shady,
or
the double meaning.
yeah. So thing is interesting. I didn't know if it would get filed through after the pop. I'm talking First Solar here. You had a real nice up day, gained $3.50, and then you had some follow through, but it's starting to leak right now a little bit. And I think you're okay. I want to see it hold 72, but don't let this fall into the gap area if you're trying to protect some longs. There's a buck gap between 69.71 and 70.77. Not a big gap. So keep an eye on that. The recent high of the move in First Solar, 75.75.
Jump over to 13F land. We had a ton of them break here last night. I'm not sure if you got a summary page for us, Spencer. I hope you do. The big one that I'm going to talk about, and Spencer will hunt down the little ones in the background, is Warren Buffett. It was disclosed that he increased his position in Apple. We knew that already, but what we didn't know is that he doubled his position in Teva. And TEVA getting a huge lift on this, trading up at 21.10 here right now. I'm not sure who was offering this thing after hours, but it traded up on the Warren stuff. And then it came back down to 20.50. And somebody sat there with an iceberg order to sell at 20.50 for like an hour straight, Joel. It must have been 1 million shares traded at 20.50. Finally took that out, and then it blasted up. So whoever was selling, they wanted out on the 20.50. Maybe they're going to be proven right in the long run, but in the short run, they're already down 60 cents. And if they did sell 1 million shares, which is a ballpark estimate for me, they're already down about $600,000 on that trade. But anyways, TEVA, nice lift here. The only concern is the last time we found out that Warren Buffett was in this was back, I believe, in January, and we saw a stock take off over $22. We know it leaked big time after that. So it's never really been the longer term trade to chase Warren. Short term, it sometimes works. Long term, I'm not coming here buying because
what happened? Well, Tubba faded on that originally, that the move was overdone, and then it disclosed that this wasn't one of Warren's picks. That he let one of his
Is that what it was?
Yeah. Well, it didn't. That news didn't come out that day, but it was disclosed that this didn't have the Oracle of Omaha's. It just wasn't his pick. I mean, he allowed it in the portfolio.
Assistant team at TT Maxx saying he's going along with
Chuck Munger, the U of M.
So did he? So is Warren in on the doubling the position here now, or is he still just kind of letting his assistant here take the reins? Because Teva's up another 80 cents here. We're getting a replay, Joel. Are you fading this?
No.
I might be fading it. I might be fading. Maybe not yet, but sometimes a day or two. But I think this thing if it gets silly, gets up near 22, I'm selling it short.
What about you? You going to stick with your VRX here? He's getting a little pop off this. This should be good for Valiant Pharmaceuticals.
Yeah, and also VRX, somebody else, we had 13Fs come out, and Spencer, you might be able to find it. Somebody else took a position in VRX too, so that might help it as well. I believe it was it Value Act? Did Value Act take a VRX position?
Look at Value Act. Value Act did something big. I wanted to follow that. That was like a week ago.
I'm going off my memory. I think Value Act took a position in VRX though, so I'm just going to go try to find that.
I don't see anything from Valiant.
I thought I saw it. I'm trying to just go hunt it down here too.
I mean, there's so many names.
There's so many.
You want me to just read you?
Yeah. Give us a summary here.
All right, I saw a lot of names from a lot of different funds. I'll just go down the list here, starting at the top. So Stanley Druckenmiller, he is holding a lot of tech. He's holding Intel, Baba, Micron, Netflix, Adobe, Microsoft, Amazon, Alphabet, Salesforce. Dan Lowe bought a lot. He bought UTX, he bought Win, he bought EA, Adobe, Salesforce, Microsoft, PBF, MPC, and MELY, Mary Echo Lima, India. He also added to his stakes in Facebook, Anthem Pharmaceuticals, LEN, WP, and VMC. Bill Ackman also bought UTX. David Einhorn, he bought IAC, TPR, ANF, BLMN, that's Bloom Brands, I think, PayPal. He bought Urban, he bought Roku, he bought SFM, and he bought ODP. That was David Einhorn. Those are kind of the biggest names. There's a bunch of other ones, but I always look at Einhorn, I always look at Loeb, and I always I'm curious about what Ackman does, and obviously we talked about Buffett already, but those are kind of the big four that I follow. Personally, there's a whole lot more. I would just Google 13F if you want, or check it out. We have every single headline in Benzinger Pro. So
nobody more influential than Buffett, though. So I've learned, over the years of 13Fs, the only ones you got to really take note of, and sometimes some of the smaller ones can move if there's a smaller company, but I'll tell you, it's Buffett. And when he adds a stock, it takes off. When he gets rid of a stock, it usually goes down. You're going to say, well, he got rid of IBM. Why is IBM not down significantly? We knew. He said on CNBC it was out of IBM. So the market already knew that information. It's new information that you sometimes get from these 13Fs that can really take off. But if Buffett adds like a mid-tier stock, like a mid-cap or something, sometimes those stocks can go up 6, 7, 10% on that news. So Buffett is the one you really got to watch. The only big move that we didn't know about was the doubling of the position in Teva, which you can see is obviously getting the benefits this morning as it's trading up 4%.
All right, let's move on. Boy, we're jumping all over the place today.
All over the place. That's how we work. We got to cover everything, Joel. We're all over the map always. Every day we're all over the map, and that's what we're supposed to be. So covering everything for you guys. To comb in the ditches to find the news here. That Benzinger Pro team is a great team there. Quick ratings. We only got 4 minutes before our guest here. Couple interesting ones here. We've got an analyst war, Spencer. Talk about this analyst war in TripAdvisor.
All right, I didn't realize we were going trips. There's lots of analysts. Lots of good analysts come. You can hear me now?
Yeah.
Lots of good. I was on mute. Sorry. And we have a vacuum in the background. So I hope you guys don't hear that too much.
I hear a vacuum. What's going on there?
What
kind of vacuum? Is this one of those
what kind of vacuum?
Is it a Roomba?
It's not a Roomba. Give me a break. It's not a Roomba. We got an analyst war in TripAdvisor this morning. Let me pull up. Oh, and Joel just yelled at them, and now they turned it off. Macquarie.
Hey, we're trying to do a radio show here. Kill the vacuum.
Macquarie upgrading TripAdvisor this morning to outperform from underperform to outperform. So they skipped neutral altogether. The double upgrade from Macquarie on TRP. Where was the downgrade? I'm not seeing that right now.
Guggenheim
Right, okay.
downgraded to sell.
Okay.
So you got the stock trading down. So I guess right now Guggenheim is more influential than Macquarie. So Macquarie basically goes from sell to buy. And Trip and Guggenheim goes to sell on the same day. So people all over Trip, they don't know whether to like it or not here. In any regard here, it's tripping a little bit because it's down 37 cents in the pre-market. But I mean, holy cow, this went from 40 to 50 on earnings. So it was a little bit overdone. Maybe you need a little bit of a pause. Pulling back here right now, Guggenheim's winning the analyst war here. Still to be determined who's going to win by the end of the day. Joel's on mute now too. Come on!
I know. I had to go.
Well, he had to run in his defense. He had to run.
He
had to yell at the vacuum guy.
She yelled at me back, but that's okay.
Yeah, she cussed you out.
Trip.
I had to mute because Joel's getting cussed out there by the janitor.
All right, moving up. I mean, not a bad call here, right? I mean, the stock had just the gap and go after earnings, got cleared $50. Where's this thing trading at 48, huh? So that's not too bad. I mean, if you're looking, I keep an eye on yesterday's low. Yesterday's low was 47.68. We haven't even taken that out. If you take out 47.68, folks, you got to look at the two lows that you had after the earnings report, and that comes in at 46.60, 44.80, and then I don't want to be long this thing if it falls into that gap area. In order to get a gap fill, you need to trade down to 40.23. I don't think you'll see that today.
AMD still trading up here with Susquehanna. It has been moving here. I still have it in my invest portfolio, but talk about a run since earnings. The stock keeps going up almost every single day. How many green candles in a row there, Joel? I'm looking at one.
Yeah, that's been. Are you even on it yet?
It's I sold. I think around here. Yeah, I think I'm pretty close. If not, yeah, I'm real close. I think I bought in the 12 handle. I'd have to go look at my cost basis. So yeah, so maybe I got to sell now. Back to even. Sell.
Okay. 1, 2, 3, 4, 5, 6. 6 out of 7. 7 out of 8. 8 out of 9 up trading days. Your only decline was on May 9th, and that was a mere decline. 12.13 traded down to 11.95. Trading at 12.65 here. Where's my double top here? On the weeklies, I see a double top at 1282 and 1288. And then you got to think about the psychological $13 level, but 15, 20 cents away from resistance and at that double weekly top at the 1285 area.
All right, we're going to take a quick break and grab our only guest of the day, Andrew Zatlin, author of Moneyball Economics. We'll be right back with Andrew. And welcome back, everyone, to this Wednesday edition of Benzinga's Pre-Market Prep. Spencer Israel, Joel Conan, Dennis Dick, now joined by Andrew Zatlin. He is the author of Moneyball Economics, a great service. I get his newsletter, highly recommend it. Andrew, how's it going this morning?
Wow, you guys are awesome. I'm happy to be here. Welcome to the pre-market show, right? This is what's happening.
Well, you're in California, right? I
am in California. Also another place where it's happening.
Well, we've got people this morning on this broadcast right now. We have people on in New York, in Canada, in Detroit, and California. So we are all over the country this morning. I hope you're not. I hope those volcanoes in Hawaii haven't reached you yet, because from what I'm seeing on the news, man, it's wild out there. But are you safe?
I'm fine. Thanks for asking. We got earthquakes, tsunamis, volcanoes. I mean, it's plague time, right?
But you have to trade through it all, because that's kind of how it works. So what's been on your radar the past few months in the market? What have you been seeing?
It's interesting you mentioned California. I'm in Silicon Valley, and we just had the retail numbers come out, and I was really fascinated by something about retail that I thought was kind of interesting. And I want to tie it to this company that's out here, not to plug them, but because I think it's one of those sign of the times kind of a thing where you start to go, uh-oh, that's worth thinking about. So retail numbers came out. They were a little softer than folks expected. But again, Moneyball economics, we nailed it. And the way we go about looking at consumer spending is probably a little different. We track gambling. We track alcohol. We track marijuana smoking. Got a 25-year history of data that goes back and strongly correlated to retail spending. Not rocket science, right? This is basically discretionary spending, what the mad money people have left in their pocket after paying for $4 gas and things like that. And it ebbs and flows, but it's really kind of interesting because, let's face it, if you're going to go out and buy drugs, you're going to have to use cash. And so it really is a cash flow way it tracks cash flow in consumers' pockets. And it has this neat 4-month lead view of what's going on in the economy. Really great track record, really great leading indicator. No surprise, right? If people are feeling good, they're going to go out drinking. They're going to go to Vegas and gamble, things like that. All right, so here's what the Vice Index said recently. It said, hey, the first quarter is going to be a little sluggish. A little financial healing has to take place because when that tax tax rebate was announced by Trump back in September, everyone pretty much pre-spent it. So last year, everyone got a little bit ahead of the curve. Early part of this year, everyone kind of had to fix their savings and the credit card situation. But the Vice Index said, oh, we're back. We're back to spending and things are going to be good. But here's where it came in and said, wait, it's going to be a little softer than you expect, right? Yes, we've got the rebates coming back from the IRS. And yes, our paychecks are a little bigger than they used to be. And yes, that means we can spend more money. But it's where that money's going that's really interesting that I want to sort of get your attention on. I don't know about you, but I have the car I need. I've got the flat panel TV. I've got the tablet. I've got all the stuff I need, all the gadgets. And it's really hard to motivate me to go out and throw away my 2-3-year-old phone now. I mean, so the next generation has a slightly better camera. What I'm saying is, in this economy, people have already loaded up on the stuff they have. And this is kind of an interesting side note. Retail numbers that you see that track what people are spending, it's a bad methodology because it only tracks things. It doesn't track cruises. It doesn't track spending on air travel. It doesn't track any of the spending that I track that really reflect what people are spending on. And so this is where it gets interesting, guys. Everyone's focused on retail numbers. Retail numbers come in soft. What does it mean? What does it mean? I want to throw out an idea to you. And the idea is people are done spending on stuff. They're spending on experiences. That's where the money's going to be going. And so if you're an investor and you're looking at consumer stocks, you want to think in terms of not of stuff, but of experiences, travel. And there's this really interesting company that came out, and it's basically layaway for travel. I don't want to name drop them, but it's this startup. And the idea is all these travel companies, all these airline companies are trying to now rope in people to start traveling, but they can't afford it. You're talking people with credit scores as low as 470. And they're getting onto this layaway plan that's been set up by this company where, it's $1,000 trip to Florida. Tell you what, you don't have that money. We'll charge you literally, guys. They're charging up to 36% annualized interest and getting people to do this. Now, I take a step back and I say, wait a second. The last time we scraped the bottom of the barrel for uncredit-worthy folks was 2007, right before the bubble popped. I want to kind of build a thesis here. And here's my thesis. On the one hand, the mainstream data that you're being presented is incomplete, right? The retail numbers, yeah, they're soft. Doesn't mean people aren't spending. It's just they've shifted what they're spending on. Okay, what are they spending on? Travel. I come out of a sales operations background. And let me tell you something. When you have a normal level of sales going on, you don't go after the folks who don't have credit worthiness. You only start going after the folks who are at the low end of the credit totem pole when you can't make your number, when you've exhausted all the natural means of selling stuff. That's when you start chasing the folks who shouldn't be allowed to get credit. And that's what we're starting to see that in this kind of weird place of travel. I mean, but let's face it, travel is pretty big. I mean, airlines, there's a lot of money. And we're starting to see companies emerge that say, you can't afford to travel. Well, we'll make it happen. What can I do to get you into this car kind of a game? and they're charging exorbitant interest rates, and they're making money off this. Why? Because people want to travel. They don't want to buy a car anymore. They already have their car. They want to travel. Everyone around us is traveling. It's the new thing, but they can't really afford it, and they shouldn't be given the money to do it. And again, I think we're at that point in time in the cycle where we've exhausted all the organic growth that's out there. Apple, the only way Apple's going to sell more iPhones is if they can find a way to get you to replace it faster. And since they don't really have any net new features, they're going to have to come up with some other gimmick to get you to throw away that 2 or 3 year old phone. What we're seeing, guys, I think, is consumer spending isn't tapped out, but I think we're close to it. I think we're not really going to get a lot more momentum, and that's scaring me in the second half of this year. That's my thesis.
Someone in our chat, BT Tokyo, remember that George Carlin actually observed this too. George Carlin said we have too much stuff, and so it looks like you and George are on the same page. So if we've peaked as far as that type of consumerism is concerned, then what's the next stage of the cycle?
All right, so here's what I think. You're talking about a guy at the top, Trump, who is the consummate showman. He is a salesman. He has always been a salesman. He understands how this played out. And remember, we rolled out the tax cut when? September, right before holiday spending. Not a coincidence. He understands the timing and the events. So I think what's going to happen is as we get into closer to midterms, you're going to start to hear some more rallying. So what the tax cut really did was pull in future spending, the usual stuff, right? Here's more money. Eventually you're going to pay the bill, but right now here's more money in your pocket. Let's crank things up. That slows down. And so then I think you're going to have a rollout of an infrastructure bill. I think you're going to start hearing the chatter again, where they're going to roll something out and say, here you go. We're going, and again, for political reasons, you time it for the midterm elections to do something that, again, it's the economy, stupid, right? But there's only, it's not a horrible place to be. By the way, our economy is strong. It's solid. The problem is outside of the U.S., it's not. Germany is, Europe's in a recession. They just don't know it, kind of a thing. China's slowing down. U.S. is really strong. But again, it's because we borrowed a little bit of our future spending. I think he's going to do the same thing. It worked once. Let's do it again. Let's do an infrastructure bill. Let's borrow $1 trillion to build bridges and stuff like that on the assumption that that will drive things. Again, if consumer spending is part real, meaning, yes, there's actual more money in my take-home paycheck, but also part smoke and mirrors, the confidence that there's something more on the horizon. For example, let's go back to the fourth quarter. The savings rate plummeted. Credit card spending surged. In other words, people were spending more than they had. Why? Because they knew that in a few months, their paychecks would be fatter and they could pay it down. We come to the end of the year, I think you're going to have a little less meat and a little bit more sizzle. Hey, we've got this infrastructure bill that's coming out. $1 trillion will be thrown into the public kitty for, again, bridges. Who knows what they're going to spend it on? And real or not, and again, even if it's real, like, yes, they signed it, it takes a long time for that money to hit. But again, it's a confidence thing. I think Trump is coming out. He just rolled one out. The pharmaceutical companies got slammed. How can we reduce costs of drugs? What's the implication? I'm putting more money into the pocket of the consumer. Again, I think some of this is more sizzle than steak, but I think that's what you're going to see. This is kind of, unfortunately, though, this is the kind of stuff you pull out at the end of a business cycle. So it's a little scary because you don't know what can be done, but it's interesting that they're throwing out every trick of the trade, but they're doling it out. They're timing it, I think, in certain ways. So I think what's going to happen is things are going to slow down over the summertime. Then you get closer to September, elections are going to be rolling up as key. I think the politicians will try to roll out, like they always do, they'll try to roll out something that will get everyone excited again. The market will take off a little bit, but there's got to be something substantial out there. Otherwise, let's face it, by the end of the year, whatever consumer spending got a boost from this tax cut, it's done. It's played out. It's been a year. So, it's sort of a now what, the magician, the Trump con game goes to the next stage.
Andrew,
that's just guess, though.
I just want to take you back to what you were saying too about, people spending on experiences, spending on travel. What do you think of the cruise line stocks then, because that's obviously experiences and travel. I look at a chart like RCL, like Royal Caribbean Cruises, which was $135 back in January. It's now 106. So it's down significantly here. Is this a good long-term buying opportunity if your thesis holds?
I think it is, and they've gotten smacked around a little bit. As let's face it, you could basically point to everyone but Amazon and say, well, they were higher in January, right? So I don't know if that's
it's true. Yeah,
I don't know if that's totally fair. But I mean, one of the things that they got hit with, and this is all transportation companies kind of got hit with this, was oil went up. I mean, oil's yet again squeezing the margins. Let me talk about this is kind of a different market. Let's talk about the sort of the Caribbean cruise lines, Royal Caribbean. They're not really catering to the basic air travel, right? They're a premium. They're charging a couple of grand to do a nice little trip around the Caribbean or wherever it is you're going, and that's different from, hey, can I just get you on a plane to Disneyland? And if so, what can I do? So let me take a step back. So what I'm saying is, if you're seeing spending go away from things like the iPhone and more towards travel, how do you take advantage of that? And you're right. The instinct should be, well, travel, let's face it, that's airlines. They're getting a little bit of pressure because of oil prices, because that is going to squeeze the margins. They're kind of down, like you noted. They're kind of down in some ways because you've got some sector rotation. But I think overall, what you want to focus on are vacancies. You know, how many empty seats are there and what the prices are for those seats. Part of what this company that I mentioned is doing is kind of, let's face it, they're getting more people to fly. And these are people who aren't going to be price sensitive. If they're going to pay 36% interest rates for a $1,000 ticket, that tells you something about, they're just glad to get on the damn plane at this point. If they can't afford a $1,000 ticket, that tells you something, right? So that's one market versus the cruise line market. And I still think that the ways to go aren't necessarily going to be on travel per se. I think the place you go is on services. And I got to tell you, look at what Amazon and Netflix have done in the last few months. Let's talk services, where people are putting their time and energy. And they've raised prices. No pushback whatsoever. Prime goes up $10. Netflix went up a couple bucks. No pushback whatsoever. That's more along the lines, not the. So I guess let me pull back. The thesis is people are spending more on services and not on things, experiences and not on things. I started off by mentioning vices. All right, check this out. In Colorado, one of the first states to legalize marijuana, beer consumption has plummeted. Booze consumption has plummeted. Marijuana consumption has gone up. It is not a coincidence. You've heard the phrase Netflix and chill. I just mentioned how Netflix can raise their prices. People are no longer really going out in Colorado. A lot more people are staying home with their buddies. It's a lot more convenient in some ways to watch the fight, watch the game. You got this awesome flat panel TV. It's cheaper. And maybe you're going to sit down. Maybe you'll drink at home. Maybe you'll get high at home. Doesn't matter. What's happening is a shift in the millennial market in the way that they're socializing. And so I wouldn't necessarily go for the travel itself. I would go more for the services that are, these things that aren't things, that are more experiences, that are catering more towards the millennials, like Netflix, like, unfortunately, Amazon, Facebook. I think, you hear about the FANG stocks, they're overbought, they're priced too high. Yeah, but if you look at wallet share, this is where folks are spending their time and money.
All right, Andrew, we're up against the clock, so we're going to have to let you go. Andrew Zatlin, author of Moneyball Economics. Thanks so much for the time this morning. Really appreciate it. Always love your insights. Have a good one.
Happy investing, guys. Take care.
All right. I don't know if there's anything else that we want to talk about, but I did want to bring up crypto quickly, but I'll do that at the I'll do that at the end. Was there something else? Were there any other stocks we wanted to talk about?
We'll just talk imbalances here. I'll just quick rundown because people like that information. Bank of America 103,000 sell. It's a trend. We've been seeing that the last couple of days. Bank stocks have had some sell imbalances there. They opened weak yesterday, but then they rallied. The reason for that was the TLT was, I believe, down. If I'm going off my memory yesterday, I think I actually did buy that Bank of America open yesterday too, and it worked out pretty well. It's a different story here today, though, because TLT is actually trading in the green a little bit here, so I don't think you're going to see that snapback rally that we saw yesterday in the financials. Alibaba, 54,000 to sell. Twitter, 90,000 to sell. Twitter continues to just kind of meander here for a little bit the last 4 trading sessions after it's had a good run from 30. It feels like it's just pausing for a breather before it might eventually go higher again. Ford 115,000 to sell, huge size in the buy in the book there, around $11 to buy. So lots of support there between 11 and 11.05 as institutional buyers are starting to really pile up there on the 11 handle. You can see it in the charts too. It's funny how sometimes, the technicals you can look at and say, oh, 11.02, 11. Joel and I will look at that and say, man, it's got to be somebody big at the point, because when it makes multiple lows in the same area there, just above $11, it makes you think there is size to buy there. And that's your reason, and that's why I'm such, a big fan of order flow, because order flow gets ahead of the charts. It tells you where there's big size, where there's trouble for a stock looming. Like just for example, and then taking on a little tangent there, Nike. Look at Nike here. You can look at this chart and say, whoa, 70, you can see, on the technicals, but, we can see it actually in the order flow as well, because we go to the book on Nike. I'll go there right now. There is actually for sale 250,000 shares at 70. That's a huge order. 200. And then there's another 70,000 at 69.90. So it's going to have trouble getting through that $70 areas. Once it gets through there, it's in breakout mode. But when you see those big sellers like that, they block the stock. Now, it is retail day here today. So if there's ever a day it could do it, it might potentially be today, but it'll have trouble off the hop trying to get through 70 because there's too much size there.
Macy's pulling back to the $32 area after $2 off the high. So it's leaky here. John Smith in the Benzinga chat here, he wants us to talk about housing stocks, Dennis. And you know what? That might be one of our most neglected sectors here on Benzinga's pre-market prep. There's a trend.
Out of favor, man.
It's out.
That's interest rates.
Yep, there you go. There you go.
Classic interest rates starting to climb up, and your housing stocks take it. Because, when you've got interest rates going up, people aren't getting as cheap of money to be upgrading or moving into a brand new house. And that is going to hurt the home builders. So it's, it's funny how these trends work out in the long run. But, interest rates, obviously, and the Fed started getting hawkish there last year. And really, we had this big run up where they bought everything, which made 0 sense. But they bought everything in January, including stocks like the housing stocks. What a great selling opportunity. LEN, for instance, got up to over $70. It's now $51 here. KB Homes got up over $38, now $25. You're talking about sell-offs of 33%. In KB Homes there. If you want to look at, there's other ones like Toll Brothers is a big one, TOL, got up to over $52, is now trading at $40. Now, at a certain point in time, we've talked about this too, Joel. I don't think interest rates are going, to the moon here again. We're not going to see 7-8%, just because the 10 years over 3 doesn't mean the world's imploding here. So at a certain point in time, these things are going to be buys as it gets overdone on the other side, just as it overshot in January on the upside. Maybe some of these are overshooting on the downside, but the environment is not favorable right now because you are still in a rising interest rate environment, and home builders are definitely impacted by rising rates.
And I'll just do some specific levels here. And really the only thing to talk about here is the support areas. And boy, you're looking at the XHB, the ETF. I mean, that is sitting on a cliff here on the daily, on the monthly charts.
Ugly.
Recent low of the move, 38.58. You're only 20 cents above that. So there could be another breakdown. This one's not a super mover, but if you do lose this 38.50 level, you may trade down to your September 2017 low at 37.98. May take like a few days to get there. Toll Brothers, all these charts are looking the same here. Toll Brothers just banging on the door here. Recent low of the move, 40.63. You have some considerable downside there. KB Homes, KBH. Man, these charts just all look. I can't believe we didn't pull these up sooner. This is on the verge of breaking its April low at 25.17. I did Toll Brothers. I did KB Homes. Oh, Lennar, the higher priced one. Oh, well, no, Lennar, boy, they gave you a shot here.
That 50 is nice, though. What do you think of 50? We're getting there.
I'm thinking, why was I looking
nice
at this thing when it went to 52.44? Let me see if I can find something. 50 here. 2 monthly lows. You're going back to August and September of 2017, 50, 12, and 49.90. But folks, just remind you that in these stocks or in this sector, the trend is not your friend.
Do you want to mention Bitcoin, Spencer?
Yeah,
so let's jump into that for a couple minutes.
not Bitcoin specifically, but the one comment that we had that struck out to me most yesterday at on the first day of the Benzinger FinTech Awards is this guy, Alex Mashinsky. He's the CEO of the Celsius Network. They have a crypto-backed lending platform, among other things. And he brought up an interesting point. He said in 5 to 10 years, the largest crypto players, whoever they are, will be larger than Apple and Google. And his logic was, there is no market in the world larger than the money market. The money is larger than everything. So he's obviously bullish crypto, and he thinks that honestly the largest players will be the biggest companies in the world within 5 or 10 years, which I thought that was a very interesting comment to make. So, and that was my favorite comment that was made yesterday.
And I was, Dennis, I'll let you comment 1 second. I also met a young man that started a fund in trading the currencies, and we're going to get him on in a week or so. But the other bullish argument for me, Dennis, is, I mean, if you just think about the different asset classes, gold, real estate, the stock market, I mean, if you just, slice off the smallest piece of the pie and you put it into, and it ends up going to Bitcoin, it's going to go a lot higher. And that's, I'm not back on the Bitcoin train yet. But, a lot of possibilities. Dennis, will let you finish with the Bitcoin rant.
I just want to say CNBC, I'll finish with my Bitcoin bearish rant, as I always do. But I just want to say on CNBC yesterday, they had Bitcoin Jesus come on and on Fast Money. And it seems like every day Fast Money just is a Bitcoin bull. Well, they bought Bitcoin Jesus. They're like, okay, here's the bull of all bulls. And Bitcoin Jesus, if you just go back to, I forget what his real name is. Do you remember his real name, Spencer?
No.
Maybe hunt that down in the background. Anyways, this was the guy that invested in Bitcoin was a buck. So he made a ton of money here. And, he's been basically the oracle of Bitcoin, if you will. So anyways, he came on the show. And last time he was on, I remember this too. So
Roger
you think he's going to, what's his name?
Roger Keith Ver.
Right. That's it.
Okay.
Roger. So Raj. So anyways, he comes on, you figure he's going to, run his bullish Bitcoin rant, but same thing he kind of did last time. He did not. He actually said, it's all about Bitcoin Cash now. It's not about Bitcoin, it's about Bitcoin Cash. And he's huge bullish Bitcoin Cash. He was saying he thinks it could triple by the end of the year. And then they're trying to get him to talk about Bitcoin because I don't know why Fast Money is so pro Bitcoin, but they keep trying to bring it back to Bitcoin Core. He keeps wanting to go on to Bitcoin Cash. And finally, he said, yeah, I think Bitcoin Core can go higher too. But you could just tell he wasn't bullish Bitcoin anymore. He's bullish Bitcoin Cash. And this is the point I'm making is even if you are bullish crypto, how do you know Bitcoin is going to be the Amazon of the crypto world? How do you know it's not going to be Bitcoin Cash? How do you know it's not going to be the next best thing? Because somebody's always creating something new here. And people, I hear this all the time. Oh, it's first mover advantage. Bitcoin was the first. They got the first mover advantage. Well, first mover advantage works well when you have a corporation that can take advantage of first mover advantage. There's no corporation in Bitcoin. It's already created. It's already set out. It's already done. We don't even know who created it for sure. So it's not like Bitcoin can adjust itself to all of a sudden, take, new, take into play new considerations that people, like maybe they invented the wheel, but maybe Bitcoin Cash is making it round. So how do you know that somebody does come out with something better than Bitcoin Cash? And then that becomes. So you got to be very careful in this industry because even if you're a believer in crypto, we don't know who the big player is going to be. So don't get married to any of these positions. Just like Roger made a lot of money with Bitcoin, he's now moved on to Bitcoin Cash. And maybe that's the way to play it. If you follow the industry closely, make sure you keep up with it because there's always something better coming out.
All right. Great rant, Dennis. We're going to wrap on that for the day. That's going to be our show for Wednesday. On tomorrow's show, Joel will be back in Detroit, right, Joel? Yep, you'll be back in
Detroit.
Yeah.
I may be working from home tomorrow. I may need to rest up after this.
Man. Okay.
Yeah, we got some good stories. I don't know if we can tell on the air.
Oh, nothing crazy. Nothing too crazy happened that I know of, at least. But anyway, that's our show for the day, folks. Hope you guys have had a good morning and have a good rest of your day. We will see you, folks, on Thursday. Have a good one.